All right, let's kick this off. Welcome, everyone. Thank you so much for joining us. You are attending Aparo's Nonprofit Bites and Insights. This is our webinar series where we have topics and speakers from all different industries come generously share their knowledge and insights with us. Today, we have Shannon Pohl from Your Part-Time Controller, or YPTC, discussing nonprofit finances, specifically around best practices for avoiding financial pitfalls. Super important. But before I turn it over to her, let me go through a few housekeeping details. So this session is being recorded and it will be uploaded and shared on our website as well as our YouTube channel. All of you who attend live today will receive a follow-up email from me. It'll include the link to the recording, as well as a slide deck and other resources we might talk about today. Q&A and chat box are available for you to use. Please use those to drop in your questions, make any comments at any time throughout the presentation. For those of you who might be new to Aparo, welcome. A little bit about us. We are a nonprofit ourselves. We are based in Charlotte, North Carolina. And essentially what we do is we help other nonprofits with any of their technology needs, challenges, barriers, any technical issues. We're here for you. We offer a wide range of services to make sure we're meeting the needs of the nonprofits, including advice, education, and solutions. So when nonprofits come in, they'll meet one-on-one with one of our tech therapists to discuss their issue, and they'll make sure that you get access to the right service and program. If you'd like to learn more, the best way is to go to our website at aparo.org. If or when you decide you'd like to access our services, the best way is to submit a request form that's on the website. Fill that out and someone will get in touch with you as soon as possible. And then finally, if you haven't already, please consider subscribing to our email list to stay updated on our programmings. That is it for me. I'm going to go ahead and stop sharing and turn it over to Shannon.
Thank you so much for having me. I'm going to go ahead and share my screen, get us started with our presentation today. All right, can everybody see that all right? Perfect.
Yes.
All right, well, thanks again for having me. My name is Shannon Pohl. I'm from YPTC. As discussed, today we're going to talk about best practices for avoiding those financial pitfalls in your nonprofits. So before we get started, just taking a minute to tell you a little bit about YPTC. That stands for Your Part-Time Controller. We're a professional services firm that is specialized in financial management for over 30 years. We've got the goal of helping our clients essentially sleep at night. That's why I really like the therapist, the tech therapist. We also, are the here to help. So we include day-to-day accounting, bookkeeping, financial reporting, data visualization. Maybe you've got a board that loves a visual dashboard. We work to help implement best practices and keep everyone up to date on GAAP principles. So we serve over 1,900 clients throughout the United States. I am here physically in Durham, North Carolina with our North Carolina market. So we also have people all over the state to help out our nonprofit clients. So a little bit about me. I've had various positions in the accounting and finance fields before merging my passion for nonprofits and my accounting skills here at YPTC. I joined back in 2021 as an associate on the remote team, and now I get to kind of move those passions even further together to work as the leader of the Raleigh-Durham market. We're, again, serving everyone throughout the state, and I just know how impactful good, timely financial information can be for organizations. So I'm thrilled to be able to work with people here in my community. And I know just to touch on it quickly, the invitation did have a second speaker. Unfortunately, Keith could not join us today, but hopefully in the future. All right, so what we're going to do here today is to really just cover some of the bigger financial pitfalls. I know there are so many different things when it comes to financial health of an organization, but hopefully when you leave today, you can take away two skills. One, essentially assessing your organization's financial health. Secondly, to recognize and interpret financial red flags within an organization. So we're going to cover that in two sections. So the first is going to be financial management best practices. So throughout, we're going to incorporate those tips in real world scenarios. And then secondly, same thing, we're going to have some case studies, some real world scenarios, and walk through some financial red flags that you may see in an organization. So that's enough about us and me. A little question to ask about the group here. Let's learn a little bit about all of you and see who's joining us today. Give it just a little bit. All right. How are we at for participation in the poll?
Doing pretty good. Just a couple more. All right. That's all. Go ahead and share.
Awesome. Okay, so we are mostly finance team members. I love that. Program team, management team, and board. That's a great mix. It's a good variety. All right, so that first section, let's talk about those best practices. So the very first thing we're going to talk about is board oversight. So that will, apply to some of our board members on the call as well, but it really helps an organization to have that clear understanding of what board oversight looks like. So we're going to cover this because it's so important. Being on a board, whether it's because your interest or your experience, comes with a lot of responsibilities. The ultimate being that fiduciary responsibility. Before we dive into that best practice discussion, we felt it was important to pause and take a moment to define what this concept is. So essentially, you're supporting an organization's mission. It's important, but we need to do it legally and ethically. Board members are stewards of public trust and must always act for the good of the organization rather than the benefit of themselves. So that's really in a snapshot, what that fiduciary responsibility is. All right, so we've got a nice graphic here to kind of break it down into these duties. So the board is not usually involved in the day-to-day activities of the organization. It is responsible for managing the organization and making important decisions such as adding or removing board members, hiring, firing key officers, engaging in audits and other professionals with the organization, as well as authorizing significant financial transactions and new program initiatives, right? If you're going to change what your organization is doing as a whole, you want the board to buy into that and make sure they have oversight on that. So board members really have these three fundamental areas of legal and fiduciary responsibility. The duty of care requires that a board member actively participate in governments, right? They're going to meetings, they are actively participating in that oversight, asking the questions when they see those red flags. This includes more than just the board meeting, it's understanding the financial documents that are being put in front of you, maybe helping to frame some strategic plans, and even taking steps to help the organization meet those mission goals. Duty of loyalty requires that a board member act in the best interest of the organization at all times. Areas of potential conflict that come up, we see often, especially with smaller boards where you have founders, maybe relatives. It's important to make sure that you know that you're loyal to the organization and put the needs of the organization above yourself. Duty of obedience requires that a board member work to ensure the organization complies with applicable laws and regulations and acts in accordance with its own bylaws and policies. Carrying out these responsibilities, members of the board are fulfilling their fiduciary duties to the organization and even the communities that they serve. All right, so now that we've covered that board oversight topic, we're going to move on to some more financial management best practices. This applies to board, but also applies to those finance members and that leadership team. So while there are a number of best practices we could share, we narrowed it down to these top 5. In the next slides, we're going to guide you through each of them with best practices that include questions that board members or the leadership team can ask in their roles. All right, number one, tone at the top. It's so important that you as a leader on, just a part of the programs or the financial department, you're exemplifying that ethical behavior that you want to see in your organization. You have to act the way that you want to see the rest of the organization act so that you're setting an example for everyone. It's taking care to protect the assets of the organization as well. So that tone at the top, thinking about, things that could go wrong with your inventory or your land or your buildings, and just making sure that you have internal controls set up to mitigate risks. So having a risk management mindset is super important. But there's a balance between being too conservative, right? We're inflexible as it relates to that, or, being not conservative enough in that term of risk. So we call it healthy skepticism as it relates to striking that balance of risk management and then, of course, making sure that operations are efficient. So a good way that a board member can help ensure that an organization's assets and reputation are protected is to ensure those proper financial policies. So the questions that you can ask within your organization to make sure these things are being followed is, are my budget to actual reports issued monthly? If there are variances, do we know why? Is there a communication on that? Is the board spending in line with mission? So maybe you're spending money for board retreats, meetings, food, things like that. You want to make sure you're keeping that in line with the organization and its mission. And so maybe you're asking yourself now, when was the last time that I updated my policies and procedures? When was that reviewed and updated? Are we actually following it? Lastly, you can ask things like, who is reviewing and approving credit cards? I know that's a big one within organizations. Who's improving our employee reimbursements, and just making sure that you have those proper financial policies in place before you do anything, because that certainly helps set that tone. Lastly, we talk about ensuring that the right people are in place to have financial management knowledge. Not all board members or executive directors are going to have formal training in nonprofit accounting. Of course, that's fine. We want to make sure that, having knowledge should not be used as an excuse to let the financial management go, but more an opportunity to learn and an opportunity to understand your organization's specific financial health. So the members of the accounting or finance department must obviously have that education and that background. Sometimes we see where management and board maybe haven't taken the time to understand that. So you have someone on your team where a great, bookkeeper, CFO, controller can help communicate that. So if you've got the wrong people in that accounting department, it does significantly heighten the risk of waste, as well as maybe certain things, these pitfalls being seen and not communicated properly. All right. Go on to this next slide. Great. So we're a little bit more on the policies and procedures, especially surrounding that cash management. We need to make sure, we're not just setting policies, but that we're actually enforcing them. So that cash distributions is key, because the ED or the CFO shouldn't be approving their own expense reimbursements, for example. Nor should this be done by someone on a staff. You can have a board member who is approving those key employee reimbursements. Daily review of the bank activity is necessary to ensure that there's no inappropriate or fraudulent transactions. So maybe you've got that policy, but we're not reviewing the cash activity to make sure it's being followed. Additionally, the finance leader shouldn't be the only one that sees the bank reconciliations or payroll reports. Review and approval of these reports by the ED will ensure that they stay informed about basic financial activities. So you do not have to have an accounting background, but it's important that you're seeing the cash disbursements going out the door. If it's possible to avoid company credit cards and never use debit cards, not using credit cards, or at least significantly decreasing their use, may be a large culture change in an organization. But at times that can be that first place for cash disbursements, falling into that pitfall of having no proper procedures in place for accountability. Of course, we can certainly help develop processes that will make sure to hold those cardholders accountable, because I know, especially in the year of 2024, when you've got people all over the place, boots on the ground, trying to do the program work, they need access to funds. So it's key to just have those controls over that. So I know we're talking a lot about separation of duties in a sound and controlled environment. So let's kind of share how that might look. All right. So the key lies in limiting that individual control over those finance functions in such a way that there's no person has complete control over a transaction from beginning to end. And again, that can be hard in those smaller organizations. So you can rely on board members or different staff. Maybe program approves, finance releases. So you've got different controls in place. So in the chart, we identified the typical finance related tasks and how they might be dispersed throughout the organization to create the appropriate separation of duties. All right, so we're going to use this example. We've got a little animation here. The person that's inputting the bills and signing the checks should not be the same person. And yes, if your entity utilizes electronic bill pay solution, that is the same thing as signing a check. Meaning if you're using bill.com, the person who's uploading it, approving it, should not be the person who's releasing it. It's often difficult, again, with those small organizations, but it is possible with involvement from other people. For example, requiring bank reconciliations and statement review by the executive director or another person that's not in the process can be super helpful. It's one of the most basic reports to say, here's the cash coming in and here's the cash coming out. Maybe having your board treasurer review or approve the expense reimbursements submitted by the executive director. That'll allow for an extra level of accountability. We know that implementing separation of duties can be difficult. So another solution is to bring in an outside consultant to perform some of the finance functions. Not only does that enhance the internal controls, but it provides access to another level of expertise. Maybe you've got one or two people in your finance department that would really just love someone to bounce some ideas off of. All right. So here is our next poll question. Whether electronic or not, within the AP process, true or false? As part of the accountant or bookkeeper should have access to enter bills, manage vendors, pay bills, and view payments. So should they have all of that access? This one should be pretty quick. Nice true and false.
About halfway there.
I know y'all weren't expecting a poll question so soon. Keeping you engaged.
There we go. All right, I'll go ahead and end it and share.
Awesome. Yes, absolutely. So that is false. No one person should have access to complete the full transaction process from entering a bill to releasing it. That is the number one area we see where people expose themselves to fraud. Not that anyone in the organization would, but we have people in and out all the time. We just want to make sure we're setting ourselves up for success and providing that assurance to our funders. All right, and we'll move on here. All right, now we're going to talk a little bit about good governance. So experienced board members should lead committees such as the Finance Committee, Audit Committee, and Investment Committee. It's not required that every board member on the Finance Committee be a financial expert, but it is the best practice to have at least one or a few individuals with that experience. A good way to get the expertise that is needed is to invite individuals to become committee members before asking them to become full board members. That way you get the expertise needed with people who may not have the time to do that full board commitment. Boards should hold regular meetings and schedule them in advance. The suggestion here, and I know it can be hard, is maybe you've got the calendar set up for the whole year. If you have to flex within that, at least you have that structure built out so people know what's coming and can plan around it. It's also really important to keep minutes of the finance committee. The auditors are going to want to see them. This is something that comes up quite a bit that we see with different organizations. It comes 990 time or it's audit time. And they're asking for board minutes, and it's a scramble sometimes. When you have a volunteer to serve on the board, you should expect them to have an orientation. So maybe you've got a guest coming in on a committee or a board meeting. You want to make sure you orient them before you pop them in there. So expect to be provided, provide with current copies of the bylaws, policies, financial statements, so they know how to govern. You should have the opportunity to speak with management and other board members, of course, as a board member or a guest, and board member expectations should be clearly laid out. All right, so there's that certain commercial out there where they say, "What's in your wallet?" Well, what should you have on your finance calendar is what we're going to talk about here. We've broken this out into a few different buckets of information. So, we talked about that meeting calendar, but the finance calendar is all inclusive of those important dates that your team needs to know. So if you've got a finance calendar, it's useful to ensure that deadlines are planned out, like your 1099s, your 990s, maybe you've got grant reporting at a certain time, audit filings. It can be useful for determining when financial statements should be completed each month. So that's what your finance department needs to know. Hey, we've got a grant report coming up, so I'm going to need those by this date. Also, it's going to be important that everyone is aware of the finance committee meeting so that you have that information available. Providing the financial statements a week in advance of a board meeting is always best to ensure that the board have sufficient time to review the materials. Be sure to share. This calendar is with all internal stakeholders. Everyone should be kept on the loop as to what the ongoing financial functions are. So we've got a couple of examples here. A good reminder is these other deadlines here where you see things like your charitable registration for North Carolina. Maybe you need to be updating your GuideStar profile so people who are looking where to donate have some trust in the organization. And we'll touch on that a little bit later as well. All right. And I will just really quick do a quick pause to see if there are any questions that have come in. I like to handle them throughout, so please don't be shy. Anything as of yet? All right. Well, you'll just keep rolling then. So there are many tools out there to help your organization communicate important deadlines. We've got a little example here. We use Microsoft Planner a lot here. It is already in your Microsoft 365, so most people do have access to it and may not even know. I use it myself for upcoming events. It's a pretty good project management tool that can give you that visual representation of like, oh, I've got this board meeting coming up. I've got this grant report due this day, and it's a good tool for sharing. Another great way to share, specifically for board members, is to utilize a board management software. There are many offerings out there, BoardSpot, Boardable, Board Pro. Some are geared towards managing a corporate board, while others are tailored more uniquely to nonprofits. They range in price, but typically have an initial implementation cost and an ongoing fee. So we estimate those total cost ranges between $2,000 to $3,000 a year. This is a great project for soliciting funding to help cover initial costs, as a lot of nonprofits can say, okay, look, we're setting up our governance. We need support in doing so. All right, we're going to talk a little bit on strategy and sustainability. Strategy and ensuring everyone has a clear picture of it is so important in an organization. It's recommended to create 3 to 5 year strategic plans that focus on that big picture. A lot of times we get in that budgeting grind or even that month-to-month report, but we don't step away and look at where we're going in that 3 to 5 years. So we're not meant to dig into the details of every little income and expense like an operating budget when you're looking strategically. Strategic plans can help identify strategies that will best enable a nonprofit to advance its mission. So, and staff of the board engage in this process, they'll become committed to measurable goals that are aligning with that mission. Monitoring, and we can move a little bit to the budget because that's part of this. So monitoring the budget is really one of the biggest duties of your leadership and your board. Not only must a board monitor performance, but it must take action if there are issues. So if you've got a variance, that's really indicating maybe a program is just not happening, or maybe we're way behind on salaries because we're understaffed. There's certain things, we can notice, but then we also want to take action. All right, a little bit on sustainability. It's important that the full board reviews the financial statements at least on a quarterly basis. During this, a board can look at that budget to actual. They can also be aware and ask certain questions like, are we able to have this, going profit or growing line where we're not constantly losing funds on this program, or maybe we are, but this other program is funding it. It helps understand really sustainability in the organization. So maybe that time the board can decide we need to set aside funds because we see where this is going. It's a huge impact to the community, but we need to set aside a reserve in case we need it for that program. So here's kind of a little bit of a sample to go on to that is a liquidity policy. So we are huge on providing examples here, and you will get a copy of these afterwards. So don't feel like you have to, I know this is the big one, don't feel like you have to read through each step, but really essentially relying on management to identify the policy for a number of months where operating expenses it needs to have on hand. We always recommend it's really sufficient to have 3 to 6 months of expenses on hand, especially for a nonprofit. We usually lean more towards that 6 month side because we know everyone, big and small, has felt, that payroll squeeze. Cash is such a huge concern. So if you can get that lift off of you to where you feel like you have sufficient reserves, that you'll be in a much better place to sleep at night and really just feel better about where things are going. Um, and of course, liquid assets are things like cash and cash equivalents. So if you've got a money market, things that can be pulled out easily. All right, so now we're going to move on to that finance department and the best practices for financial reporting. It's very important to hire individuals with proper skill sets. You want the confidence that the organization has a qualified team in place and that they can also hire other people if they need more capacity. It's tempting, we've seen it, to utilize volunteers. Not that many people are skilled specifically in nonprofit accounting. It can be a bit of a learning curve. So volunteers can be used in meaningful ways, maybe in other ways in the organization, or if they truly are an expert, then you're going to use them similar to like a pro bono lawyer where you're going to want to record that gift in kind. Right. It's also important to have efficient systems. Don't allow yourself to be stuck in the mindset of we've always done it this way. One example I can use is even post 2020, I see a lot of physical check signing, whether it's just convenient or they just haven't taken the steps to do those electronic bill pay systems. I had an organization, for an example, that was receiving in the mail their invoices, going to the post office, taking them to somebody else, getting a signature, taking them back, and then going to the post office after they stuff all the envelopes. We know that's not the best use of everyone's time. So technology can certainly help out in certain situations and save some time so you've got more time to focus on that mission. All right. You also want to ensure that your bank and other significant balance sheet reconciliations are completed monthly. This is huge to help prep for the audit, but also to catch any issues. So if you reconcile cash first, and then you work your way down your balance sheet to make sure your AP ledger is in place, you don't have anything outstanding that you can't justify. You've looked over all of your receivables to make sure that they're true and accurate. Maybe you've got a pledge on there from 5 years ago that you're not going to collect. You want to make sure not only do you know what's in those accounts, but you also correct if necessary. So reconciling each one of those balance sheet accounts is key, and it keeps you audit ready, making sure you're documenting that in a work paper. And then lastly, you want to make sure you've got timely reports. The goal should be to receive financial reports within the first 2 weeks after month end. This means if you're not seeing monthly financial reports, we need to be asking like what's preventing a monthly close timeline. Maybe it's a funding report that you can only do at a certain time, but just understanding those hangups. At a minimum, you should expect to receive a balance sheet, income statement, and cash flow statement. Here, I know as part of our package, we do a memo just to highlight the areas of key importance. Not everyone loves staring at those statements, and we understand that. So we try to put those in words and translate that, maybe even some visuals for some important metrics for your organization. We also try to, with that, go beyond one of the big things that we do for our clients is cash forecasting, working with you to know what's coming so you can see where you're going to get into those cash crunches. All right, so the members of that accounting or finance department must have the right education and background, as we talked about, similar to your program staff. You want them to be primed and ready to go. So we often see that a lot of times people don't test credentials or maybe have the right questions to ask for understanding when you're looking to hire a finance person. And at times, I'll give the example of, and we help our clients do this as well, but we do it for ourselves, is we have a quick 10-minute accounting test. I recently helped a client who had a professional service provide CFO candidates to them. 80% of those candidates could not pass the simple debits and credit test at a CFO level. So unfortunately, either it's someone who's been outside of it for a while and maybe they're working more towards the operations side. It can happen, and we really want to see people be able to have that education. So whether your team needs education where they're at, or you are looking to hire someone, it's important to make sure that you're vetting them. All right, so we're going to do some examples of what maybe a staff accountant or a controller would handle. So some specific examples right here is a staff accountant might perform the accounts payable, the amounts that you owe your vendors, and accounts receivable. So maybe you've got a staff accountant handling your receivables and your payables. And then maybe they're tuned into that chart of accounts. They know where to code things, what grants they go to. So they're also handling that coding and that grant monitoring. At year end, they're also doing your 1099 prep because they've been so keyed into that accounts payable. A controller, on the other hand, is going to focus less on those transactional side duties and more on the reporting and the analytics. So when you're filling open positions, management may consider employing the services of a professional for one or two of these positions, depending who you have on your team. And of course, the number of positions and who's there looks different for each organization. All right, we talked a little bit on that accounts payable automation and what that looks like. So there's a little example here of bill.com. So right here, you can see it's got a nice approval tracking. So you can see clearly we've got someone who, populated the bill, and then you're going to find an approver. And then that also you're going to work with your staff accountant to make sure you're correctly classifying and maybe putting certain things to a grant in the coding in that bill.com. All right into that roles transparency and accountability. So this is important because charity watchdogs, as we talked about earlier, like GuideStar and Charity Navigator and other nonprofits and professional funders are watching. This is public information. So some ways to improve that transparency and accountability is to share your audit and your Form 990 on the company's website, right next to that annual report. Conduct compensation reviews for key management positions. There are a lot of resources, salary data out there to help with this. Invite finance staff to board meetings so they can participate in the financial conversations and learn more about what's going on in the organization. Don't exclude your staff when you're having those big strategic conversations. This is especially relevant during budget season, as you're going to want that finance staff to be keyed into where you're going. Finally, obtaining a GuideStar platform platinum level seal of transparency. Now, you may be wondering what that is. We'll go into that just a little bit. It's important to know that you don't want this to fall off the radar. A lot of times, this is where people start when they're looking up your organization. I know personally we do, to get a sense of where the organization is at, what their goals are. A lot of times you can put your mission and your program details in there as well. All of this says to everyone who's looking it up, we are being transparent and we want to share with you where we're at. So the seal levels go bronze, silver, gold, and platinum being the highest. The bronze is going to be issued when you give basic information, you give a little more financial details, you get your silver seal. And then as you add that qualitative data like goals and strategy, you're looking at the gold. And then finally, platinum is when you really have all of those pieces in together. All right, second section. We're going to talk about those financial red flags that maybe are indicated we're headed for somewhere like a pitfall. So board members and leadership play a crucial role in overseeing and reviewing key financial documents, and that's where those red flags often are going to pop out. So we'll start from the board perspective. A board member's main responsibility is listed here. Primarily, we're going to talk about approving the budget. Board members may also be involved in policy decisions that affect the budget, such as retaining certain programs. Should we, do this again this year, or maybe the funding, is costing us more than we thought and it's not making the impact that we thought. Should there be changes in program fees, ticket prices, maybe hours of operation? Are we considering personnel raises or bonuses? Do we need to acquire large assets or repairs? Another important function as a board member is to monitor those variances to the budget. So you did all that work to set that up. You want to make sure that if some of those key understandings are being shown as a variance on a budget to actual, that we're talking about it, but something might have changed. So we're gonna look at these red flags. So failure to take actions. Let's say we see that we didn't get a large grant that funds a program and no one's asking questions about it. Obviously, that's going to have some major pitfalls in the future if we don't take action to either collect from the funder or find a different funding source. All right, next poll question. I gave it a little longer between them this time. So who should be involved in creating the budget? Give it a little bit.
A couple more.
Absolutely. All of the above. An operating budget should be a joint effort. I think a lot of times it gets put at that key responsibility of finance, but finance doesn't have a crystal ball. They need to collaborate with programs. They need to, have visibility into other parts of the organization. So finance may be the gatekeepers. They may, be the ones holding this information, but it really comes down to collaboration to get an accurate budget. All right. Little graphic of our responsibilities for operating budgets to give an idea of what it might look like and who does what roles. When we look at it, you'll see that everyone's involved. People have responsibilities throughout the year too. It is so important to make sure that we're looking at that budget to actual to see if any assumptions have changed. So you can see right here, we've got several people involved, at least 5, if not more. And we want to make sure not only are they compiling it, they're understanding what's in it, they're developing goals, but we're overseeing that and we're taking it in. Maybe we just really all overshot this year, right? We want to make sure next year we're all in that process again to learn from what happened throughout the year. And a little legend down here. When we talk about KPIs, we're talking about key performance indicators. So a little example of what a draft budget might look like. So looking at this, maybe the board has some questions. Maybe they're looking at that program budget for the diabetes education and management, and it's projecting a deficit. It's not a bad thing, but it is important to ask why. Maybe they're planning to spend down donor restricted funds that they received in a prior year. These are just all assumptions that you want to go hand in hand with that budget. Right. See what another question is. Looks like fundraising doesn't have enough net to cover overhead expenses. So at that point, are we asking ourselves, is there, we're getting 24,000 from fundraising, but our general and administrative is 166,000. So are we looking at different areas to fund these positions? And what does that mean for going concern for the positions in that salaries and wages bucket? And then we're looking at that overall deficit. Is the board okay with that? Are we using donor restricted funds from a prior year? Are we intentionally planning to dip into the reserves? All things you want to be prepared for. All right, we're going to touch on some board responsibilities, but this also applies to leadership when you look at financial statements. So we want to review those monthly or quarterly, depending on your size. We want to discuss them with the management and the finance team, and we want to ask questions. It may be nice to sit in a finance committee meeting where everyone's still and quiet, but that really just says to me when that happens that they're not paying attention, they're not asking the right questions. So some of those red flags could be, maybe there's a lack of expertise from either side, and we're just maybe not reporting something correctly and no one's seeing it. Or maybe we have an excessive reliance on restricted funds. As we saw with that last example, there wasn't enough to cover general and administration, and we want to make sure that there is. So these are all red flags that everyone should be looking out for on those financial statements. And then, of course, we talked a lot about this, but that low liquidity. How much cash do we have to cover upcoming expenses? So here's a quick snapshot of an actual financial statement, of course, scrubbed for information and privacy. In this example, this is a nonprofit that had an operating deficit, but it's almost buried because of the total positive change in net assets. So in this example, the nonprofit can sustain the operational loss. However, if that operational loss is consistent, that should raise a red flag. For how many years can we sustain this? Are we making actions to correct it? This entity also has a significant amount of donor restricted net assets. This places a burden on management to spend those contributions according to the donor's wishes. So those dollars aren't even available for those general and administrative positions. In this example, there's a story here worth exploring. Either the nonprofit is struggling to spend down prior year donor restricted funds, or they're holding on to them for a specific reason. Maybe it's a capital campaign or a new building. If the latter is the case, think how helpful it would be if the capital campaign was moved to its own section on the financial statements. So maybe instead of it buried in there with your education program, you want to pull it out separately to say, this is my capital campaign. We should also mention that this is a nonprofit undergoing a capital campaign to purchase a new building. So that's why that was used for the example. All right. So these red flags, once we do see them, we're going to talk a little bit more about some board responsibilities. Again, this does fall to leadership as well. We're going to talk about overseeing the selection of the audit and the audit process. The board should meet with auditors. They should prepare that audit and share it with the board, review and accept it before it's issued the final. And then, of course, you want to review the governance letter and the management internal control letter after that audit is done. So red flags in that audit process, maybe there's delays in management providing the information. Maybe there's a modified audit opinion. Significant adjusting entries are always a huge red flag because it means we didn't do our due diligence prior to the audit. And then, of course, going concern issues. I'm going to talk a little bit about some common reporting issues auditors have been seeing lately, some of these trends that we've seen. So failure to record in kind. In kind are those gifts and those non-financial assets. I know we touched a little bit on that about people with skills, volunteering, use of a building. Maybe you have a lower than fair market value rent. Maybe you've got a volunteer who's acting as management. you want to make sure that all of that is captured on your financial statements. So under the current guidance, non-financial assets are required to be reported on a separate line and then described in the notes. So for example, if you had gift in kind from a law office, they did pro bono services of $6,000. You got an invoice, or you know how much they normally charge, and you've got that for free. So you're going to want to include that as revenue, and then you're also going to want to include that as legal expense because it was. And if you didn't have those pro bono services, you would have had to go out there and pay that fee. Another pitfall we see is failure to release donor-imposed restrictions. We get those dollars, we account for them correctly, but no one is tracking the expenditures. So I don't have a report to say, oh, program spent those dollars already, but we didn't earmark them to release the restrictions. We see that often, and then it eats out of your unrestricted funding and makes things look inaccurate on your financial statements. Another one we see is missing balance sheet schedules. So for every asset and liability, you should have a work paper that goes with that to say exactly what it is. Maybe that liability was already paid and we didn't reconcile that account, so it's still sitting out there on the balance sheet. A lot of times people are looking at things maybe from more of a cash perspective, and they're not thinking about that balance sheet account. Lastly, it's failure to analyze revenue streams for appropriate recognition. So incorrect recording of contributions for grants. We see a lot of, maybe you've got a complicated agreement, but at the end of the day, it's multi-year and you're getting $200,000 over 5 years. You most likely have to record that entire $200,000 in that current year, and you have to recognize whether it's conditional, restricted, or unrestricted. And if you can't explain that to an auditor, then that a lot of times will pop out very quickly. Auditors are meant to communicate the deficiencies in your controls or failures in the operation of internal controls. So maybe you have great controls, but they interviewed and chatted with somebody about what they did and they found out they weren't being followed. So you really want to get the value from that financial audit, listen, read, respond to those auditor communications. That is your to-do list, and that's where your auditors add value. You pay a lot of money for that audit. You want to make sure you're getting your value out of it. It's not just for your funders, it's for you too. Okay, last poll question. So maybe, we talked about what to do with the audit. What's the number one thing you want to do to ensure after you're completed your financial audit? Everything's done, it's wrapped up, the board's approved it. What's the first thing we want to do? There's some fun answers in there, so hopefully this ends us off on a decent note. All right. Everyone agrees, although I was hoping for some fun answers. And we do say maybe it's a tie between taking the auditors out to lunch and recording the entries, but you definitely want to record those entries. We see a lot of times people pay a lot of money, spend a lot of time for audits, don't record the entries, come next year, things don't balance. So definitely make sure you record those audit adjusting entries, but you guys got this, 100%. All right, before I move on, because we can always end here if we need to, I wanted to see if there were any questions.
Yep, we had a question around what software are you using to generate the statement of activities example?
So that specific example likely came out of a QBO or something similar, and we put it in our own format. We have in the past used Excel templates where sometimes software can fall short depending on what you've got and what you want to see. But we recently have an in-house software that helps us as an internal tool to take that raw data from different accounting softwares and put it in a format that we want to see. So it was probably QBO with a little bit of finessing at the end.
Is there a best practice for the number of people on your finance committee?
Yeah, and it really depends on the organization size and the mix of people that you have. I've seen anywhere from 2 to around 10. I think if you get too many people in the room, that either leads to half of them being disengaged because one person is speaking up all the time. Um, but also if you don't have enough, then you're not really getting a good varied opinion. So it depends on the organization size. You at least want a treasurer and somebody that's outside of the organization, just to make sure that you've got good governance. But we see the sweet spot, I'd say, sits around 5 for what I see.
Sorry, going back to the QBO, just wanted to confirm. So you cannot create the report in QBO,
Let me
correct?
take a look at that specifics line. We'll go back here just a little bit. That statement of activity. So for this, you absolutely could. Aside from maybe some formatting things that we added, we often will have ways of finessing that chart of accounts in QBO because it is the most cost effective for a lot of organizations, and you can absolutely track your grants in QuickBooks. QuickBooks has a lot of features that allow you to segment the data the way you need it. So for this example, I've used locations in QuickBooks before to do the without donor restriction columns. I've also used classes for functions, whether you've got programs, fundraising, management in general. So when it comes 990 time, you can quickly pull that out of QuickBooks. And then lastly, we've used projects to track grants. So this is one look. If I were to pull this out of QuickBooks, it would, in the way I set up my chart of accounts generally, it would be with locations. And you can get that current year and prior year. So aside from some formatting, you could get this basic report out of QuickBooks.
Right. What are some alternatives to Bill.com?
I've seen different people use different things. Ramp is one that I've seen, and we always use whatever our preferred software of our clients are. So we don't have a preference, which is what works best for your organization. So I've seen people use Ramp. I know Avid Exchange is another one that people like to use. Anything that is cost effective for your organization. We tend to use Bill as an example a lot because we do have post retail pricing with them, so we can offer our clients a little bit better solution. But there's lots of options out there, and we never keep people from, I get a few people that say, just don't care for Bill. That's fine. We can find something else that maybe integrates or can easily be integrated, exported, and imported into your software. So you don't have to do everything externally and then bring it back in.
What is the difference between a 1099 and a W-2 employee?
That's key. And I cannot provide tax or employment law advice. I always start with that. But this is something I went to a training on recently. It is a big red flag to the IRS, and they do not care if you're for profit or nonprofit if you are paying 1099 individuals that are actually employees. So a lot of the red flags that they'll look for is control, right? And assets. One of the things that I listened to a CPA firm talk about was work computers. Did you buy a laptop for that person? If so, they're probably an employee because they didn't come with their own tools. Are they coming with their own tools and their own expertise and providing you a service? Or are they really your employee who is using all of your resources on your schedule to execute? So there's a lot of different tests that can be done, but that control test and that resource test, I think, are two big ones. We see it a lot where the organizations decide to switch from W-2 to 1099. Our key, reminder is to document why you did that. Because that's what they're going to ask. Well, did you look at these different tests of control? And I know the IRS has great information on this on their website as well, but you need to document why you made a decision to switch from one to another because they're going to see the taxes fall off and wonder why. So that's always a huge one.
Finally, can we get a copy of your accounting test?
Oh, I do think that's proprietary only because we usually charge to administer it. But there are a lot of great resources out there, and I can give you a couple examples of what it kind of looks like. So it literally takes 10 minutes. It is the first section is a list of very common accounts like cash, accounts payable, accrued expenses, net assets, and we ask people to identify what the regular balance is for that account, whether it's a debit or credit, right? You want your people in your finance team to know to increase cash, do I debit or credit it? Those are pretty basic accounting things. The next section is that same list of accounts. We ask them to tell us what type of account it is. So is this an asset, an equity, a liability, or income or expense? That way, you get an understanding that they know where those are going to fall in the financial statement. And then the last one is 3 to 4 really short narratives of very common transactions. And I always recommend people customize this for their organization. What are the things you record the most, right? So then you're going to say, okay, we received free legal services of 2 hours. They regularly charge $300 an hour. What's the entry? You want that person to know gifts in kind, legal expense, to be able to do that simple math right then and there. So whatever's, happening for your organization, we always suggest you give them a couple key narratives that they could put into an entry for you.
Great. We got a few more come in. How would you prioritize which best practices to improve with first, second, etc.?
I'd say first is probably that board oversight, just kind of in the way we presented it. Second is making sure you have the right people in the finance department. Those two things are going to allow you to set up the policies and bylaws, as well as start to develop your processes within the team and have that separation of duties.
Is there an available detailed 1099 versus employee test?
That is a great question. I will look up on the IRS website where they've got that information. It's different for every organization. It's going to be different for the auditor they send out, I'm sure. As with the IRS, there's so many interpretations. But I think there are some key factors, and there's a lot of materials out there online that you can find, but this is a good topic to maybe present in the future.
Absolutely, yeah.
Could talk forever on that.
Let's see. How are offshore services viewed for resources that are hired to complete tasks?
So it just depends on how it works for you and that service works. We do, I get spam emails in my account that say bookkeeper for $10 an hour. A, that's not a living wage. B, I can't imagine that person has the expertise that you're getting from a service that has a higher premium attached to it. Some people do use an offshore for like those staff accountant times, those transaction volumes, right? You've got huge AP. It's all relevant to that service, but I just caution to be careful. You get what you pay for.
You have how about a copy of chart of accounts for nonprofits?
Yeah, so we do take an approach here at YPTC of very individualized. We can, when you see the slides here, this will be great for that, statement of activity here, but it's different for every organization, but we can certainly include some examples when I send the slides over. But we don't do that boilerplate, like everyone has to have the same chart of accounts, because we know some people need to track one thing while somebody else needs to track something different. Within the nonprofit world, there's everything from museums to clubs to theaters. So many different organizations with different needs.
Thank you for answering all those questions and for the audience questions. I do want to take a moment, Shannon, if you could share a little bit more about your part-time controller and if someone's interested, what they can do to get started.
Take us to the end here, and please excuse my rapid clicking. But yeah, again, YPTC is here to help with any and all of those things. Maybe you'd like a just customized chart of accounts. We work on an hourly basis. We do not do audits. We are part of your team helping with that financial management. So again, we don't give the audit and the tax advice, but we work with your CPAs. So maybe you've got a team and you just need some extra capacity, or they need some consulting, or you're just looking at building out your team and you need someone to come in and do those monthly financial reports. So we have staff accountants all the way up to CFO level people who can do everything from bookkeeping to strategic planning, and beyond. We have a lot of tools and resources. We're 700 across the nation. I love that because we're very collaborative. If I don't know the answer, somebody else does. So we have a really good network here to rely on, but we work with you as your accounting team, giving you the reporting needs that you need. So not just making you sure you're audit ready, which is basic. We also want to make sure you are getting those key insights and finding those red flags sooner rather than later. Little bit about how we work. We can do in person, we can do remote. We've got people, like I said, across the state and across the country.
Perfect. Well, thank you so much. We are at time. Really quickly, I did drop the survey link in the chat. If you can take a moment to click on that, so it'll open up. Thank you so much, Shannon, for this great information. A lot of tips and tricks in here. If you can send that over, I will be sure to share the deck with our attendees today. Everyone else, thank you so much for joining us. Expect that follow-up email from me. It'll include the link to the recording, the slide deck, some of the resources that we talked about today. And then that's it. Have a great rest of your week and see you guys next time.
Thanks for
Bye.
letting me share.